Hey, real quick, let me ask you something. What do you think matters most in the world economy? Price? Speed? Efficiency? Actually, as you know, that answer used to be obvious. For 30 years, the whole global system was built on one simple idea. Whoever makes it cheapest wins. That was it. That was the whole game. And for a long time, it worked. But now, the question has completely changed. It's no longer who makes it cheapest. It's who can cut it off, who controls the chips, who locks down the minerals, who owns the cables carrying 99% of the world's internet, and who decides which AI supercomputers get built, and where. This is the new game, and it affects everyone. Free trade isn't dead, but it has been armed. Today we're going to talk about how the world economy became a weapon. Before we dive in, have you ever wondered why your phone got more expensive? Or why AI servers keep getting built in specific countries? Let's go back. After the Cold War ended, the world made a deal, not a written one, but everyone agreed. Efficiency above all. The idea was simple. Every country does what it does best. Taiwan makes chips. Congo digs cobalt. Mexico assembles cars. Vietnam sews clothes. This is called comparative advantage. And when everyone does it, goods get cheaper, supply chains get longer, and the world gets richer. In theory, the WTO held it all together. Rules, tariff negotiations, dispute resolution, a referee for the biggest economic game in history, and it worked. Global trade grew from about $6 trillion in 1995 to over $30 trillion by 2025. That's a five-fold increase in 30 years. Prices stayed low. Inflation was contained. Stuff you bought at the store came from everywhere, and that was a feature, not a bug. But here's the thing no one talked about. The longer the supply chain, the more efficient, but also the more fragile. Like a perfect spider web, beautiful when nothing touches it. But one small break, and the whole thing trembles. The world had built a very efficient, very breakable system. Think about it. Do you know where your laptop's components come from? Probably 5 different countries. That's the world we built. Then came the shocks. Not one. Not two. A cascade of them. And each one revealed exactly how fragile the efficiency-first system really was. 2020. COVID hits. Suddenly there are no masks, no ventilators, no medicine. Everything that kept people alive was made somewhere else. 2021. Chip shortage. Millions of cars couldn't be finished. Factories sat idle, all because of a few tiny semiconductors made in just a handful of places. 2022, Russia invades Ukraine. Europe discovers it has been heating its homes with Russian gas, and now can't afford to keep doing that. 3 crises, 3 different supply chains, all pointing to the same problem. Dependency had become vulnerability. Efficiency had become a trap. So governments started asking a different question. Not, where can we make this cheapest? But, what happens if someone cuts us off? The IMF and WTO together tracked it. Trade policy activity, meaning how often governments used tariffs, subsidies, export controls, flat for a decade. Then around 2019, it exploded. By 2024, import restriction measures were covering 11.8% of world imports. That's not a blip. That's a structural shift. The rules of the game had changed. China restricted rare earth exports. The US tightened chip controls. Export bans on industrial raw materials increased 5-fold in just 13 years. Scary, right? But wait, it gets more specific. Let's look at what this actually does to the world economy. Chapter by chapter. First impact. And this one hits you directly in your wallet. When supply chains fragment for security reasons, the world pays a price. A literal price. The IMF forecast is simple but sobering. Global growth, 3.3% in 2024, 3.2% in 2025, 3.1% in 2026. Each year, a little slower, and protectionism is one reason why. Here's why. For 30 years, global supply chains were the world's great disinflationary engine. Cheap labor, cheap logistics, cheap everything. When you move production back home for security reasons, those costs go up. You pay more. Your neighbor pays more. Everyone pays more. The IMF specifically warned that domestic production expansion, building factories at home instead of buying from abroad, keeps consumer prices higher for longer. And it's not just inflation, it's misallocated resources. If a country builds chip factories when it has no competitive advantage in chips, that's money that could have gone elsewhere. The World Bank agrees. Trade tension escalation is listed as a key downside risk for global growth heading into 2026. This isn't abstract economics. It means slower hiring, less investment, longer waits for the next phone upgrade you want. The efficiency loss is real and it accumulates. You might be thinking, okay, a little slower growth, higher prices, is that really so bad? Hold on. The supply chain story gets way more interesting. Second impact. And this one reshapes the map. Here's what people get wrong about deglobalization. The supply chains aren't disappearing, they're splitting. Think of it like a river. It used to flow in one channel, now it's splitting into multiple streams. A US-aligned stream, a China-aligned stream, and a murky middle. Semiconductors. Over 90% of leading-edge logic chips come from one company, TSMC, on one island, Taiwan. And 3 companies control 80% of chip design software. Critical minerals. China controls 70% of global graphite extraction and nearly 100% of graphite processing. That's not a supply chain. That's a choke point. In April 2025, China suspended exports of rare earth magnets. Global automakers, German, Indian, Japanese, immediately warned of production halts. That's choke point power in action. So what happens next? Companies and countries start looking for detours. Vietnam becomes the factory floor for what used to be made in China. Mexico picks up electronics. IMF research calls these connector countries. They benefit in the short run. More factories, more jobs. But they also become the new fragile link if tensions escalate further. The OECD modeled it. If OECD and non-OECD trade were cut by just 10%, GDP losses range from nearly 0 to 1.7% per country. And the knock-on effects last year's? So here's a question for you. If your country's supply chain gets rerouted through Vietnam or Mexico, is that good news or bad? Honestly, it depends on who you ask. Third impact. And this one surprises people. Even money and capital investment is no longer flowing freely. It's now filtered through a political lens. In the old world, capital went wherever returns were highest. If the factory in Vietnam earned more, money went to Vietnam. Simple, rational, efficient. Now, governments are asking whether that foreign investment is a security risk. Is the buyer connected to a government we don't trust? Are they acquiring sensitive technology? Investment screening, where governments review foreign acquisitions, has gone from rare to routine. Over 80% of OECD countries now operate investment review mechanisms. In Finland alone, the share of investment proposals subject to review jumped from 3.7% in 2017 to 22% in 2023. That's a 6-fold increase in just 6 years. Sectors under scrutiny: semiconductors, AI, quantum computing, critical raw materials, energy, food supply, healthcare. Basically, anything that matters is now political. The U.S. is now considering requiring foreign nations to invest in U.S. AI data centers as a condition for buying American AI chips. Saudi Arabia already agreed. Geopolitics meets capitalism. What does this mean for global productivity? It means capital doesn't go to the most efficient place anymore. It goes to the most politically safe place. That has a cost. Fourth impact. And this one might be the most important for the next decade, because the new battleground isn't factories or ships. It's data, compute, and cables. Submarine cables. You've probably never thought about them, but 99% of all international internet traffic, every email, video call, cloud backup, travels through about 300 undersea cables. Those cables have landing stations. Those stations are on sovereign territory. And increasingly, governments are asking who owns the cable, who can access the data. The WTO's e-commerce moratorium, which prevented countries from taxing digital downloads and streaming, expired in March 2026. Some countries want to start taxing digital trade. Meanwhile, AI competition has become infrastructure competition. Building powerful AI means access to high-end chips, giant data centers, massive electricity grids, and fast networks. The US and Netherlands have restricted chip-making equipment sales to China. In April 2026, US politicians proposed the Match Act to extend those restrictions to allied nations. China accounted for 33% of ASML's chip equipment sales in 2025. That figure is expected to drop to 20% in 2026. One political decision is reshaping billions in trade. This is what Henry Farrell and Abraham Newman call weaponized interdependence. Control the hub of the network, SWIFT, internet exchange points, chip tools, and you control leverage. Think about this. 70% of global web traffic reportedly goes through Amazon Web Services servers in Northern Virginia. One location. Does that worry you a little? Fifth impact. And this is the one that doesn't make headlines enough. All of these shifts, the new security economy, that don't hurt everyone equally. The US and China are building their own blocks. Europe is rearming its industrial policy. But what about smaller, poorer countries? What about the ones stuck in between? Unk'd put it bluntly, the reshaping of trade policy norms will hit small, vulnerable developing countries hardest. Tariff hikes, debt burdens, and climate stress all pile on at once. Think about it structurally. A rich country can build chip factories with government subsidies. A poor country can't. A rich country can diversify supply chains. A poor country can't easily take critical minerals. Congo produces 78% of the world's cobalt, but Chinese investors control most of the downstream processing. Congo digs it, China refines it, everyone else buys it. And when countries like DRC try to impose export bans to capture more value locally, it often just leads to more Chinese investment on Chinese terms. The power asymmetry remains. UNCTAD also makes a point most economists miss. Trade and finance can't be separated. Dollar strength, credit tightening. These financial conditions directly affect what poor countries can import or export. Small firms in developing countries are especially vulnerable. They lack the capacity to navigate unpredictable trade environments. They can't hire trade lawyers. They can't lobby governments. The bottom line from UNCTAD: waiving new U.S. tariffs on the most vulnerable economies would protect their development and have only marginal effects on the U.S. trade deficit. So let's put it all together. The world isn't returning to the Cold War. Two hermetically sealed blocks isn't what's happening. Reality is messier and more interesting. World goods and services trade reached a record $34.65 trillion in 2025, up 7% year on year. Trade is not collapsing, but the conditions under which it happens are changing fast. The WTO reports that 72% of world trade now happens on a most favored nation basis, meaning non-preferential, open rules. Just a few years ago, that number was higher. The share is falling. Here's the framework that explains it best. The world economy is being layered, not broken, not closed, but selectively opened, based on alliances, sanctions, tech controls, and investment screening. Trade still flows, but it's increasingly filtered by who you're allied with, what tech you're allowed to use, and whether your investment passes a national security review. Investment still flows, but 80% of OECD countries now screen it for security risks. Capital doesn't just chase returns anymore. It chases safety and returns. Digital trade still grows, but data flows, AI infrastructure, and internet architecture are increasingly governed by which block you're in, not just which website you visit. UNCTAD proposes something important. Multilateral trade rules must evolve. Sustainable development has to anchor the system. Networked multilateralism, not bilateral power games, is the path forward. But here's the honest reality. That path is getting harder. The IMF warns prolonged uncertainty and escalating protectionism will make growth weaker. Policy instability is the new normal. So here's what we know for sure. The question of the global economy has permanently changed. It used to be, who can make this cheapest? Now it's, who controls the chips, the minerals, the cables, and the data centers? And who can afford to cut someone else off? The answer determines prices, growth, and inequality for decades. Free trade isn't over, but free trade is no longer neutral. Every chip export, every mineral deal, every cable route, every investment, it all comes with a political price tag now. So I want to leave you with one question. If the world economy is now a security system as much as a trading system, Who do you think is best positioned to win that game? That's a wrap for today. The world economy didn't collapse. It just got a lot more complicated and a lot more interesting. Stay curious, and I'll see you next time.